You may be tempted to skip this one, but for the sake of your sanity, your account balance, everything, and everyone you hold dear, there is no good reason to. This chapter will make you cringe, but don't you dare put this book down. I promise you will be glad you didn't. The Forex industry is full of scammers. They prey on newbies because they know that it's easy to impress them with affluent lifestyles and screenshots of winning trades. They know that new traders aren't thinking about risk-to-reward ratios, money management skills, or losses. This is why they're able to sucker people in and rip them off with their fake signals, fake MyFX book records, fake screenshots, fake signal services, manipulated trades, and fake dollar bills splayed on their borrowed MacBooks and rented Airbnbs that they claim they own. Read this chapter and you won't be one of the sheep they lead to the slaughter. Hey loser. Most new traders think that the way to making their bread and butter and then some is to have the highest leverage a broker could offer, the highest lot sizes their accounts can take on a single trade, and the highest account balance possible. So, they start off risking more money they can lose, and they eventually blow their accounts. People have lost their homes and families because of this unrealistic view of the markets. There's no need to be one of them. First things first, how much money do you want to put into your very first trading account? Before you answer that, let me tell you this, you're going to lose it. Well, that's not a very nice thing to say, right? Did you choose to read this book because you want to be told costly lies or because you want to make money? I assume it's the latter. Of course, you're going to make money, but first things first, you need to understand and accept that you're going to lose money. To put things in better perspective, every trader who puts trade on is a losing trader. When your order goes live, you are immediately in the red until the price goes your way. Also, every newbie trader will lose money. It's part of the learning process. Just think of it as the cost of learning to make more money than you've ever dreamed by just clicking a red button or a blue one. Here's something else you need to know. You want to lose money. I know that sounds confusing, but listen, you want to lose money now and fast. The sooner you do, the more immune you become to the idea of losing money, and the faster you can move your attention away from your cash and pips to percentages. If you start off as a winning trader right off the bat, you're going to get cocky and arrogant, and sooner or later, the market will humble you. Unfortunately, that humbling could be very expensive, so it's better to have that experience now and at a lower price. So let's get back to the question. How much money will you put in your first trading account? $100,000? Make it $10,000. And if it's $10,000, make it $1,000. If it's $1,000, make it $100. I know you probably think a tenth of your original amount is too small to make anything significant, but this isn't about making money right now. It's about managing your emotions around money so that you can make money consistently. 90% of traders lose money, and it's not because they have terrible strategies. It's not because their broker keeps hitting their stops, although some brokers do that. It's not because they don't work at Wall Street. So what's the real reason? It's because they don't have the first clue about managing their emotions around money. Sure, they have all the fancy indicators and EAs with the bells and whistles, but not a clue how important it is to manage your risk, your money, and the person you see in the mirror every morning. I'll prove it to you. Risk-reward ratios. Say you have a strategy that gives you a win rate of 30%. Which is the lowest win rate you should have, otherwise you really need to fine-tune your system or you won't make any money. This means for every 10 trades you take, you lose 7 and you win 3. Let's assume that you risk 1% of your account balance and you're trading with $100. I know it's not a sexy figure, but that's the point. You must wean your mind off of money for now. If your trade setups give you 3 times your risk each time, a 1-to-3 risk-to-reward ratio, let's work out the math. If you lose $7 for every 10 trades you take, but you make $9 on your profitable trades, this means you're up $2. With a risk-reward ratio of 1 to 5, you may lose $7 for every 10 trades you take, but your winning trades are $5 each, which come up to $15, so you're not positive by $8. If your win rate is only 20% and your risk reward is 1 to 5, you lose $8 but you make 2 because your gross profit is $10. Are you starting to get the picture? Everyone's always looking for the holy grail of trading strategies. They want hundreds of thousands of pips and a 200% win rate. I'll tell you this for free, it does not exist. Actually, there is a holy grail, but I'll share that with you at the end of the book. The point of this is simple. You always want to make sure your risk-reward ratio is at least 1 to 3. Some people say 1 to 2 or 1 to 1. I say keep it at 1 to 3, even if you're starting out. This is also why you should reduce your trading balance by 1/10, so you're not too bothered by your losses. Don't get me wrong, you'll hate losing, but you won't want to jump off a cliff because you just lost $1 million loan either. In this book, you have so many strategies you can use to get 1 to 3 setups. It's not impossible for you. If you trade higher time frame setups with lower time frame entries, a 1 to 10 risk-reward ratio is possible. But, again, it all comes down to your ability to be patient. If you aren't, don't worry. The market teaches all of us to be patient, assuming you don't quit just because of a few blown accounts, and you continue to study what works and discard what doesn't. Percentages, not pips, not dollars. If someone said, "Hey, I make 3% every week," most new traders would follow that up with the question, "Okay, but how much do you make though?" This focus on dollar figures and the number of pips leads to greed and terrible trading decisions. Yes, the goal is to make money, but you won't do that obsessing over how much you pulled in. What you need to understand is that 3% a week is fantastic. Even 3% a month is excellent. Why? 3% could be 3% of $1 million, which is $30,000. Not a lousy trading month at all. Focusing on dollar signs is what leads to taking profits too early. As I've demonstrated, this is a terrible thing to do because it makes it more likely that you will blow your account when the losing streak comes. And it comes for everyone, even the pros. If it didn't, no one would bother talking about defining risk and managing money properly. Money management. Risk management is about working out your risk and taking steps to reduce it, while money management is about reducing your losses and maximizing your wins. Can't lose it? Don't trade it. We've already discussed rule number 1. You should only trade what you can afford to lose. Not only should you reduce the capital you start off with by 1/10, but you should also make sure that every month you have a fixed percentage of losses you're willing to take, and after that, you will close your platform and walk away till the next month. Don't trade with money that you need to survive on either, because that will do your head in when you lose. Don't know your risk per trade? Don't take the trade. Next, work out your allowed risk for each trade. Some people have a fixed sum of money in their heads. That can work too, as long as you keep the reward 3 times that amount and you're not going overboard with the trading. For example, you could decide when you're more profitable to risk $50 for every $5,000 you have. If you take only 10 trades a day, then you know you won't risk more than $500 that day. The trouble with risking fixed amounts is you don't account for the wins or losses you make. You could have a winning streak and grow your account exponentially, or you could have a losing streak and lose by a whole lot. Others risk a fixed percentage of their account balance. So a $10,000 account means you will only risk $200 on any given trade if your risk per trade is 2%. The good thing about this method is that your risk matches your account balance. When you're on a winning streak, your account grows accordingly, and so does the amount of money you can risk on subsequent trades. Conversely, when you lose, your risk per trade will reduce along with your balance, meaning it might take you a while to make your money back if you don't have a sound higher time frame strategy. Make your risk-reward ratio work for you. You already know about the risk-to-reward ratios, 1 to 3 only. If a trade setup doesn't give you at least 3 times what you're risking, let it go. The market will generously give you a better setup another time. Leverage is your friend and your enemy. I've addressed this at the start of the book in that it allows you to take on larger positions than your account can handle. So if you have a 1 to 200 leverage on a number 500 account, you can open up a position worth $100,000. Sounds incredible, but it is a double-edged sword you might fall on if you haven't learned to be disciplined or don't follow your trading rules. You could make more, but you could also lose more. So just because a broker offers you 1 to 1,000 leverage does not mean you should take it. Withdraw your profit. You earned it. Finally, you should withdraw your earnings when you make them. Most traders starting out don't withdraw their profits as often as they should. So when you finally make a good amount on your trades, withdraw it and spend it on something meaningful. This will show you that you can make a living trading Forex and that you, in fact, just did that. It also keeps the fire fresh within you to dance with the markets week after week. Set up your trading rules where you can see them. You could write, I won't risk more than 2% of my total account balance at any given time in the market. I will only take trades with a 1 to 3 risk-reward ratio or more. I will stop trading for the week if I lose 5% of my account. You can adjust that list accordingly. Reduce your risk after losing a trade. For example, if you risked 2%, cut it down to 1% on the next trade. If you lose that one again, cut it down to 0.5%. If you lose that one, cut it down to 0.25% and continue to trade that risk until your account is back up where it was before you lost 1%. Then take it back up to 0.5%. If you're taking the higher time frame trades I've talked about repeatedly, you will find this very beneficial. Also, when you trade like this, your equity curve looks smooth and beautiful, and you can get people to invest with you when you are accredited to trade on others' behalf, of course. Cut your risk in half after a string of winners. Ideally, cut them in half if you have 5 winners in a row. This keeps your emotions in check so you don't get a big head and go higher when you should trade smaller. Besides, the more your account balance grows, the less risk you need to take on to make the same significant amounts you did in the past. Also, you protect yourself against a losing streak this way and keep that equity curve looking healthy. Mindset. You must make peace with losing. The way to do that is to understand that one bad trade doesn't make you a bad trader. You could be right about the direction, but wrong about that trade. Other times, the trade was right, but the market pulled one of its stunts. It happens. Please don't beat yourself up when you have losing trades or blow your accounts. With time, patience, and practice, you will begin to see some consistency in your trading. When you feel like risking more than you should, remind yourself that the name of the game is longevity. You want to make sure, even if you have a string of losers when the market starts to do as you expect again and gives you the best setups, you have money to trade them. What's the point in blowing it all on one trade? Think about the magic of compound interest and let it work in your favor. You make money in Forex not by risking everything you have, but by taking quality setups that continue to pay you. Consider hunting for trades daily or weekly, and you'll start to see why you shouldn't bother with lower time frames, other than to get tighter entries and stop losses. Stop and check in with how you feel before you open up the charts. Our emotions affect us more than we know. If you don't feel great that day, don't trade. If not, you'll lose money and wish you had just stayed away. Review your trades, especially the losers. You learn more from your losses than your wins, so don't be afraid to analyze failed trades. This is how you become a better trader. Think long term. Yes, it would be lovely to have that Lambo and flex on your haters, but that shouldn't be your goal. Instead, focus on learning first, and then you will learn for sure. Meditate. I can't stress this enough. You only need 10 to 15 minutes each day to see results. You will notice you trade with a calmer approach, not jumping willy-nilly at every pip that moves. Spend as much time as you can with your charts. A strange thing happens the more you look at the charts. You start to see things that you realize in the back of your mind you always knew were there, but now they're a lot clearer to you. This is how you develop that trader's intuition that pros have. Stay off trading forums. Seriously, if you can just choose one strategy and learn the ins and outs of it, it will pay you. Trading forums can be incredibly toxic sometimes, full of failed traders looking to tell you it can't be done, or your strategy sucks. Some traders share setups completely against your bias, and you change your mind about your trade only to learn you were right. Leave the forums and focus on yourself. Get a mentor. Find someone who knows the ropes, someone who actually makes withdrawals and can prove it. Shadow them, learn from them, and you will see exponential growth. Spotting trade setups. The professional trader needs to know how to spot a trade opportunity and apply their trading plan to take advantage of it. Traders take their time to figure out what's happening in the market and then strategically position themselves to take advantage of each chance they see to take pips out of the market. Your trading routine. Make time to analyze the market. First things first, you must examine the currency pairs you want to trade. You can't just hop out of bed first thing in the morning and say, "Yep, I'm feeling lucky. Just gonna go short on the dollar CAD with max lots. YOLO!" If you think this is how that works, you might want to stop following those Instagram traders and focus on improving your skills. The more often you analyze the market, the better you'll get at telling where it's likely to go and what it's expected to do, which means you will paradoxically need less time to look at the charts with time. You should keep yourself up to date on what happened in the markets day after day, as it's easier than trying to soak up information that spans many days. So before you take up trading, think long and hard about your routine and how much time you can realistically spend on the charts. If you only have a few minutes or so a day, you should focus on just a couple of currency pairs. If you have more time, you can look at more. Be willing to spend an hour each day to look at your charts and keep track of news and other events if you trade fundamentals. Even if you don't know when the news events are coming so that you're prepared to manage running positions as needed, and you don't place a trade right when there's important news and your spreads go crazy, losing you money. In your trading routine, you should consider the following: key support and resistance levels on higher time frames, multiple time frame analysis to learn where the lower time frames are at relative to what's happening on the higher ones, daily and weekly candle closes and price action, economic data on the currencies you trade, which comes out overnight or while you were away from the charts, the possible impact of upcoming news events on the price of your chosen pairs, general market sentiment and commentaries to glean what every other trader is thinking and planning. Is this a lot to fit into an hour? At first, perhaps. Still, as you do this more often, you will find your flow and it will go faster for you. Multi-time frame analysis. If you open up a currency pair on various time frames, the differences in the price action immediately jump at you, but at their core, they're essentially telling the same story about what price has done, just on different time frames. The highest time frame gives you the broad strokes along the vital areas to look at. The middle one tells you where the price is at and what it might be doing next. And the smallest time frame, H1 in this example, is where you should be hunting for your entries. Multiple time frame is not really that complicated, and it gets easier the more you look at the charts with different time frames. With time, you'll be able to tell that if you jump from the daily chart to the 5-minute chart, you should see a double bottom or a wedge that formed. There's really no other way to learn this stuff than to put in the work. So on your charting platform, mark out the most recent highest high and lowest low on the daily time frame for your pairs. Then, highlight all the price actions that took place in that range on the higher time frame. Note the swing points and areas where price violently moves away from. Highlight those separately as well. Then, drop down to a smaller time frame and see what played out at those key levels. Really, look out for breaks in market structure, chart patterns, engulfing candles, and more. Then drop down to an even lower time frame to work out what happened. Your brain will start to get used to the patterns and see things you might have missed before. Spend time doing this exercise and you will see for yourself how useful it is. Even if you decide you're going to scalp the 1-minute charts, here's a piece of advice that will put you way ahead of millions of losing traders. Always check the monthly, weekly, and daily candles and price action in general. They will show you where the most critical levels to focus your trading on are. The power and accuracy of technical analysis on the higher time frames is a perfect edge to have in your trading. So please, never skip this. Don't keep your focus on one tree and miss the whole forest because it'll hurt you badly in the long run. resistance and support are taken out like so much nothing on the lower time frames. Patterns are invalidated like they never even existed too. However, when you trade in line with a higher time frame bias, your trading will be dead on, mostly, and you can pull in more money than most with a defined risk per trade. The thing about weeklies and dailies is that their levels don't fluctuate as often as the lower time frames. You can trust them and you don't have to update those levels incessantly. To see the power of trading in line with higher time frames rather than daily, check out each currency pair one every time frame and notice how much more explosive price patterns are when they show up on the higher time frames than on the lower ones. You get several opportunities to enjoy hundreds of pips over and over thanks to using the daily chart or higher. The importance of trend lines. Trend lines are outstanding, as long as you keep adjusting them as price makes new swings for you to use. To work out support and resistance levels that coincide with trend lines, just connect swing highs and lows together. For ascending trend lines that show support, draw your trend line from the lowest and most recent swing low to the highest and most recent swing low. The descending trend line, which acts as resistance, connects the highest most recent swing high to the lowest most recent swing high. You should always draw your trend lines from left to right. Always remember that the value of a trend line over time will adjust along with the price. When you find an upward trend line, the value will be higher later on. When you find a downward one, the value will go down over time. You can use the trend lines to place your orders based on your trade bias. However, trend lines can be broken, so keep that in mind. When that happens, you could simply hop to a lower time frame and see how to get in with the new trend. Whatever you do, always draw your trend lines on higher time frames from the 4-hour chart and onwards. There are several ways to trade this line. First, you can trade away from it, letting it act as support or resistance when price hits it after a down move or up to move. Second, you could wait for the price to break it and then break back in so you can fade the fake out and get your pips. Or you could choose to follow the breakout if you believe the exchange price should shoot through and continue in a new trend. Finally, you could use the trend line to get you into an already ongoing trend if you missed the start by selling on the pullbacks to it and taking profits at the most recent swing high or low. The lows and highs of trading. You could choose to focus on the highs and lows of a period as support and resistance. To find these levels from the highs and lows is just to notice the highest prices and lowest prices, but allow some wiggle room of about 5 to 15 pips because brokers all have different price feeds and spreads, and you want to make sure you're not knocked out of a trade. Looking at the daily candles, you can easily spot the most critical highs and lows. However, on smaller time frames, it's never evident which ones matter and which ones don't. Just look for areas on the chart where there has been a significant movement away from. As a rule of thumb, the sharper price moves away from a level, the more critical that level is. By sharper, I mean price doesn't dawdle, and the candle or series of candles tend to be larger bodied than usual for that currency on that time frame. By the same token, the slower price moves away from a level, the less important it is. So you can look out for long wicks on your lower time frames when searching for signs that an old high just might be resistance or an old low is acting as support. Here's a quick note on trading algorithms and expert advisors, who aren't actual people but just a programmed trading system. A lot of them work with the breaks of old highs and lows. You can also use those breaks to give you trade signals, but to use them, you must wait for the candlestick of the time frame you're observing the level at to close beyond the low or high in question. For instance, some systems want to break and close above a high or a low before going long or short. That is what works best for short-term strategies. A longer-term system will need the daily low to break with a closed daily candle before shorting. This is just one more way to use the close of a period to confirm that a trend line or support and resistance break is indeed valid. When you enter your trade, make sure you have a stop loss in place if that is not a valid trade. Fibonacci retracements. On your charting platform, you should have several Fibonacci tools. You're interested in the Fibonacci retracement, to be specific. Draw them once there's been a significant movement in price that is clear as day, and then the price starts to pull back in the other direction. When the daily Fibonacci levels break, this could be a significant opportunity for you, providing you with a trading signal. Also, Fibonacci retracements are excellent levels to take profits at before price comes back to take back all the pips you got and then some. Use these levels to place your stop losses as well. One level to always look out for when it comes to Fibonacci is the 76.4 retracement level. It will give you turning points in price, especially with the more volatile GBP crosses, GBP USD, and gold. Please keep in mind that you can draw fibs wherever you want to, but they are only as significant as the size of the huge impulsive move. The stronger and more momentous the push to the upside or downside, the more importance the Fibonacci levels, fib levels, will have regarding your trading. So, you would do well to draw your fibs on the daily charts so you can find the most important movements in price to place your fibs on. To draw fibs on a downtrend, you should connect the highest swing high of the range you're working with to the lowest swing low formed after price makes a pullback. When drawing fibs in an uptrend, connect the lowest swing low of the range you're working with to the highest swing high after the price has started to pull back down. Momentum, timing, entries, and exits. You should study the momentum of price to help you figure out the timing of your trade for entries and exits. You don't want to get in a trade and have to sit in it for longer than you're used to because there wasn't enough momentum to send it your way. Also, you don't want to sit in a trade while momentum dwindles unless you are sure it will pick up again. You can look at the various time frames available to you to work out if the price has chances of hitting your take profit or your stop loss. For example, suppose you find that the price has found support on the hourly chart and gone up because it's oversold, and on the 4-hour, the momentum shows you signs that the move is almost over. In that case, consider exiting your trade rather than waiting for it to hit your take profit level. However, if it turns out that the weekly, daily, and 4-hour charts are telling you the price will continue to move your way, but the hourly chart claims it won't, then you should definitely ignore the hourly and maintain your higher time frame focus. This is easier said than done because you might want to take your money and run. However, letting your profits run is how you win this game. That and cutting your losses short. If you're so nervous about losing that you can't even sleep or look away from your charts, then your lot size and leverage are way too large for that account. You want to only risk money that won't bother you if you lose it. Keep in mind that the momentum is just one of many tools to help you work out the speed of price, and it's not always an indicator of direction. For instance, you should be very suspicious when the price begins to move too hard and too fast. Ask yourself where it's going and then go wait for that level before taking a trade or figuring out what you need to do. Momentum can come during stop hunts when the central banks seek liquidity to take in the opposite direction. So whatever you do, never chase trades you didn't plan for. To phrase that better, never chase trades, period. You'll get burned if you try. Using candlestick formations. Candlestick patterns are useful tools, but they're only as effective as the context they appear in. For instance, you wouldn't try to sell triple top in a downtrend unless you're using a higher time frame to pick your short bias. On the other hand, reversal patterns are great on a higher time frame because they can give you massive rewards. Many trading gurus and books tell you that you can pay attention to candlestick patterns in any time frame they form. Still, the pros who actually trade for a living know the higher time frames are judge, jury, and executioner. They have a lot more significance than any other time frame out there. A candlestick pattern that shows up on the weekly chart or a daily chart offers you explosive movement worth hundreds of pips over the coming weeks and days. While other newbies are scratching their heads, wondering why the price is rallying or dropping with such ferocity, you will know it's because there was a clear signal it would do so on one of these time frames. Again, that significantly increases your trading edge. Also, candlesticks on the daily and weekly time frames offer you very well-defined price levels so that you can look for reactions within a smaller time frame. This is why you should take your time to look at these levels. You might say to yourself, "But then I won't trade every day." But trading is not like a desk job where you must work 9 to 5. The best traders know this and never try to force a trade. They just wait for their levels to be hit, and then they execute their plan. Besides, there are so many Forex pairs you could trade, so you should find a good setup or two easily each week that will pay you more than your job or bank ever will, so why rush? There is a catch with the daily and weekly candlesticks though. They will only give you a general direction to look at, like a recent push to the upside that seems just about ripe for a drop back down. The Forex market requires that you think in terms of probabilities, so it's not that the price must go down or reverse completely, it might just stall there. Realize that candlestick patterns don't necessarily give you entry and exit prices, so trading them requires a lot of faith because your stop will be higher, unless you do the intelligent thing and drop down to a lower time frame after you've got your higher time frame confirmation. Look for your best setups and then get in the trade. A daily double top means the price should drop, but it doesn't mean the price will drop right away or drop from that candle's close. It might need to take one last little push to the upside first before it makes its way down. Managing the trade. Now you're in a trade and all you have to do is let the Forex gods do their thing and give you some money, right? Well, that's not how it works. You can't just sit by and do nothing like it's a casino and you've placed your best and that's it. Unless that's actually a crucial part of your strategy, in which case, please ignore me. For the most part, you will need to keep an eye on your trades because the market is a very dynamic place. New things happen every second. This doesn't mean you should never take your eyes off the charts, but it does mean you should be ready at a moment's notice to adjust if you get clear evidence from your charts that you should be exiting your trade, taking partials, or trailing your stops to protect what's yours. How much managing you have to do comes down to the kind of trading you're doing. Scalping, swinging, or day trading, as well as the market conditions you're working with, whether trending or ranging. If your strategy is long to medium term and your stop loss is wider than other traders, you will likely have a set and forget approach to trading. However, it doesn't hurt to stay on top of the market. To prevent prematurely exiting, you should have clear parameters that will tell you when you should do something or sit on your hands. There's really no option for day traders and scalpers but to remain on top of what's going on. They're looking to take smaller pieces of the pie, and things can change a little too fast on the lower time frames where movement comes with speed and is temporary. If you have a strategy that only captures the tiny price movements, you will need to be more proactive about protecting your wins and keeping your risk minimal because short-term reversals can take you out of the game. Also, the shorter time frames mean you should plan your exits accordingly. You can't be held for 450 pips when the idea you framed your trade on is based on the 1-minute chart. That right there is how to lose your account 101. You should be gunning for 10 to 50 pips or an excellent average of 20 because those numbers are more realistic for the lower time frames. Keep an eye out for news events and price action while you're in a trade. There could be unexpected news that may or may not work out in your favor. For example, if you're in a trade and price suddenly rallies by 100 pips because of an event, don't let those pips get away. Instead, you can trail your stop, or better yet, close part of your position. Or, if you prefer, you can do both, making sure you don't trail your stop so close to the price that you lose out on even more gains if the price continues in your favor. You should already have figured out how much money you're willing to lose before you get in a trade. Most newbies only ever think about the money. They don't think about the very real fact that they could lose. It's why they go and bet the farm and then lose their shirts when things don't go how they wanted them to. So always know what your risk is. Figure out how much you want to lose on that trade, pinpoint where you want your stop loss to be relative to the spot price, and then use an online risk calculator to help you determine what your lot size should be. Factor in your trading commissions as well if your broker charges you for those. Whatever you do, your stop loss should only move to secure profits, not allow losses. Some people get so cocky or hopeful, and then they adjust their stop losses as the trade goes against them, sure the price won't take them out, or hoping it doesn't anyway. Then, just like that, they've taken on an even more significant loss than they were planning for. If it helps you, don't think of yourself as a Forex trader, but a risk manager. Your only job is to protect your capital at all costs. Any benefits you accrue from trading are just bonuses. It doesn't sound fun, I know, but trust me, you will grow your account beyond your imaginations with this mindset. This is why you should only risk what you can lose. A general rule of thumb is only to risk 2% of your account per trade. The trouble with this is that some people follow that rule, but then they open a bajillion positions, and then when things go against them, they lose a lot. So, here's what I'm suggesting to you. Never have more than 2% of your account in total exposure to the market. In other words, if you're going to risk 2% on a trade, then that had better be your only trade until it is played out entirely or until you have secured at least 6% in profits before you put on another. Even better, you can allocate 0.25% to each trade. This should be an amount you're okay with losing. If your account is large, which it shouldn't be until you have doubled a small account at least, then you might want to risk even less per trade. With 0.25%, you can put on 8 trades at any single time. This allows you to diversify your risk and take advantage of other pairs if you're looking at more than one. Using alerts. Your charting platform can be set up to send you email alerts or push notifications so that you know when the price is at your level of interest. Just look up how to do that on your trading platform. For MT4, you might need an EA, expert advisor. Otherwise, all you'll get are sound and pop-up alerts. If you can't have sound, some good, free EAs out there can be set up to send you price alerts on your mobile MT4 or as email alerts. Using alerts is a great way to keep you informed of what the market is doing. It also helps you sit on your hands and not interrupt your trades when you're a set and forget trader. This is because you'll only get an alert if your trade has smashed the take profit level or your stop loss has been hit. If you can't run your computer all the time, you should consider investing in a VPS. Your charting platform and/or broker should be able to offer you this service, and it's relatively cheap too. With the VPS, you can set up your EAs and alerts, and even when your computer isn't online, you'll get alerts about what's going on with your price levels or with your trade. This is a worthwhile investment, especially if you have a day job and can't keep taking time off work to look at the markets. But please, don't assume that these alerts will do anything to your trade. You must set the orders or adjust them yourself. All they do is let you know when the specific price you're interested in has been reached. Has the thought occurred to you that you could set an alert at a price if your trade isn't working out rather than a stop loss? Please don't do this. The markets can move so fast sometimes that by the time you open up your platform to close the trade, you'd be lucky if you still had any ammo left to take shots at the charts with. Your broker executes your orders, not your price alerts. Watch other markets. There are other markets besides the Forex market, like commodities, bonds, and stocks. Over the long term, they have shown that they correlate with the Forex market. However, they aren't as reliable as predictors of what will happen with currencies in the shorter term. Still, there are very vital relationships between the other markets and the currency market. After all, these markets need currency to exist. These relationships mainly affect the US dollar, which is king, because the US economy is the world's leader. So you want to see what's happening in other markets so you know if they're confirming your bias and price movement in the Forex markets or if there's some fishy contradiction going on. Again, you can't trade based on the information you get from these markets in the short term, but you will definitely be ahead of the curve and able to anticipate emerging trends in the coming months and quarters at least. US Treasury yields. This is definitely worth checking in with, as it will show you the general direction that the US interest rates will be headed in. You want to focus on the US 10-year Treasury note yield because this is the one interest rate worth watching. Also, notice the shorter-term yields like the 2-year notes and the 3-month Treasury bills. When the yields rise, this is bullish for the dollar and bearish for other currencies. When they fall, it's bearish for the dollar and bullish for other currencies. If the yields are bullish, yet the dollar isn't rising, that means there are other things at play suppressing the dollar, and bullish traders need to keep their eyes wide open. If the yields drop and the dollar drops along with it, you should see lower interest rates. You must watch the bond yield's price action, as it can show you different scenarios going on in the market. If it moves in alignment with the interest rate expectations because of Fed comments or other events, chances are you will know the direction of the US dollar. If it's on account of uncertainty in the market or anything else like Europe's debt concerns, then you might see the dollar affected positively. The more dramatic the change in yields, the louder the message from the bond market. If you see that the yield has changed over 1%, this should make you sit up. Safe havens. Silver and gold are precious metals used to hedge against inflation. When the faith in U.S. economy goes down, people flock to these metals because they're real, physical, finite, and valuable, unlike the U.S. dollar, which the Fed prints and prints ad infinitum, as a government-sanctioned scam called quantitative easing. So it's no surprise that lately silver and gold have seen a lot more demand as alternatives to the almighty dollar. The euro also has its own fair share of struggles. For this reason, gold and silver will move in the opposite direction to the dollar. This is called inverse correlation. Trying to work out any short-term correlation is a really tricky thing to do. Silver and gold, for all they're worth, aren't as liquid as the dollar. Also, the only reason they are in high demand is because of what happens with currencies. So look for evidence that the US dollar is plummeting or rising. You can tell by looking at the price of those precious metals. If the dollar is flying, then you know the metals are falling, or at least they should be, and that's a good thing because it means you can trust the gains the dollar is making. However, if the dollar is rallying and gold is still holding a steady price or even rallying right along with the greenback, then that means you should be very suspicious of the dollar's strength. Black gold. Let's talk about oil. This black, liquid gold is just like real gold, silver, and other commodities in that it is inversely correlated with the US dollar over the long term. In other words, if oil is up, then the dollar is down, and if oil is down, then the dollar is up. However, just like with the precious metals, you have to beware of the correlations in the short term, as they aren't reliable. Oil, in particular, is susceptible to demand and supply shocks that only affect it and nothing else. Also, there's an asymmetric bias to its relationship with the US dollar, which means that oil will have strength on a falling dollar but may not necessarily grow weak just because the dollar is rising, all things being equal. Keep an eye out for the developments in price so that you have an idea of what might happen with the interest rates and the economic growth. When oil prices are higher, there are usually rising inflation pressures which can subsequently cause interest rates to go higher. Also, higher oil prices can reduce the economy's growth as personal consumption of this black gold goes down. Between both, the impact oil has on economic growth matters more on account of how quickly consumers react to oil price fluctuations. However, interest rate changes will need more time. The rapid growth of emerging markets has led to a worldwide demand for this liquid, so oil is starting to serve as a tool to measure global economic growth. Stocks. Over the long term, and in particular the last decade, there hasn't been much correlation between currencies and the stock market. Still, from 2008 to 2009, when the great financial crisis happened, there's been more correlation between Forex and stocks, particularly when it comes to the US dollar. The connection is a risk-on, risk-off one, in that stocks are assets considered risk-seeking and the dollar is a safe haven asset. Put simply, if you're doing well, you don't mind spending some dollars on stocks or having your risk on the market. If you think stocks are terrible right now and you're broke anyway, you'd rather liquidate them and have your dollars or risk off. Investors will purchase dollars to buy U.S. Treasury debt, which is the perfect safe harbor. Recently, here's how this has played out. When the market is bullish, investors heartily open their arms to the risk and spend their dollars on stocks. This causes a drop in the demand for dollars, which causes the dollar to lose strength. When everything goes south, the investors dump their stocks and rush right back to the safe, loving arms of the greenback and the U.S. Treasuries. As long as financial issues plague the global economy, this relationship remains relatively fixed. However, suppose there are financial and economic conditions that improve things so that things are almost normal. In that case, chances are Forex and stocks will go back to having lower correlations. Tweaking your trade plan with time. Like most traders, once you're in a position, you're aware of every pip that moves for you and against you. If your eyes are on the screen, of course. So, with each little movement in your floating profits and losses, you feel all kinds of emotions from ecstasy to grief. There's nothing unusual about this, especially initially, since what matters the most in your eyes is the profit and loss balance. What's weirdly overlooked by traders for some reason is the idea of time. The price of an asset remains where it is for a long while, or it just keeps bouncing about in a range, but time relentlessly marches on. Submitting yourself to time is a skill you need to learn as a trader. You know what's going on with the price right now. The only thing that needs to be answered is, where will the market head next? When you think about it, it all comes down to time. It's easy to look at a chart and figure out possible levels price will head to, at least once you've studied the charts for long enough. But then everyone seems to forget that time is a factor. When backtesting strategies or going over past candles, it's easy to forget that each candlestick represents price action over a time frame. So ask yourself, can you be patient? Can you submit to time and sit on your hands unless or until you're supposed to act? As time passes, things happen on the charts. You have daily fixings and options expiring, among other things. These are when you can expect a rush of activity, though this doesn't always play out that way. As time passes, you also get closer to scheduled data and news events. The market expectations are priced in the days and hours before the news release. When the time draws close, the market goes quiet. There isn't much speculation because everyone is waiting to react to whatever happens. Then, just before the figures are released, things get erratic with the price as traders liquidate positions or pile in their OCO orders to capitalize on whatever happens next. The price chops around but never goes anywhere really. These things happen because of the news event and time as well. Objectively speaking, as time passes on, it can add more importance to the movements of the price that have taken place already. It can also take away from the significance of price. As a result, many trading signals are generated. For example, say the price fails to close below a trendline support on an hourly chart. This could indicate that the break was a false one and that price really wants to head back up and beyond old highs. However, if the break happened by 9:04, you won't know about it until the hourly candle closes 56 minutes later. More signals pop up from the longer time frames, like a daily candle close above a higher time frame trend line or an old daily swing high. For this reason, you need to be aware of what's happening with the price so that you can make any necessary adjustments to your trade. Say you're taking trades using trend lines. First, you must know that the price levels you get from your trend lines will change depending on its slope or angle to your chart's horizontal axis. The steeper this slope is, the more the change will be to the significant price level with time. Conversely, the shallower the slope of the trend line, the less critical the price will be when it touches it, so you might want to avoid trading that. With your charting platform, you can work out almost accurately where price will get to in the future of your trend line to remain valid support or resistance. To do this, slide your cursor along the line, then look at the time it lines up at the bottom of your chart. Are you starting to understand the many ways in which time matters in Forex? The same idea applies to longer-term charts, but the shifts in price are far less dramatic, which means a trend line on an hourly chart may adjust its levels every 12 hours or 6 hours by 10 or 15 pips, while the daily charts will have their levels shift by 10 to 30 pips over some days. The rules aren't set in stone on this. It all comes down to the angle of the trend line in question. Regardless of the time frame you plan your trades on, you want to keep the shifting trend line levels in mind, especially if you use them for trading. This also means you will need to adjust your orders. For short-term positions and overnight ones, you should think about where the trend line resistance or support will be in the next 6 hours or 12 hours at the most, while your position remains active but you can't monitor your charts. It might help to use a trailing stop. For your limit entries, if they are based on a trend line slope, you will have to adjust your order every now and then so that it still works out in line with the changes in price relative to the trend line. If you don't do this, you may miss a trade entry when the price hits the trend line or get triggered too late at a lousy price. When trading breakouts, major trend lines that seem to be so far away in 1 week might suddenly be really close by the next week or two. This means your outlook on the market should adjust accordingly. Or, the market may be homing in on a particular low or high as the trigger for a breakout when your sloping trend line at that level is the main point for the momentous move. New events, new adjustments. As you work on your trading plan, you should really make a habit of looking at the news calendar to see the events that line up for the week ahead. It bears repeating because you do not want to be caught unawares when the central banks push the price to places that hurt you. Always check for the scheduled events to come, even in a trade. If you follow this top religiously, you will reduce the odds of your trades being blown out of the water by predictable and expected events, expected by everyone and their grandmother but you. Keeping an eye on news events will also make it possible for you to forecast where the price wants to go and where there should be strong reactions for you to take advantage of. Take the time to look at the news if you haven't been doing so since you began your trading journey. Look at what happens to the price from a higher time frame perspective with each high-impact news release. Also, study the levels created over the days leading up to the news event on a lower time frame. Remember how I mentioned that news excites the market for a bit, but then the market must get back in line with the trend? You'll start to see how this plays out often, and with the intel you get, you will know precisely how to trade the move that comes after the news when things have settled down at last. Tightening your stop-loss order. You must be aggressive about protecting your capital. You're no ordinary trader. You're a risk manager, so managing risk should be the chief goal. Imagine you've sat in a trade for days, and it's been going your way for about 150 pips, but you didn't take some profits and you didn't bother to move your stop-loss to break even either. Then suddenly, the price comes right back down and not only smacks you out of the trade, but takes your money too. How would that feel? Not very good, I imagine. Or here's another scenario. It's never going to happen, but just roll with it. Your boss asks you to put in overtime at work. You agree to it, and he said he'll pay you extra on top of your usual daily take-home on the condition that you take off at precisely 6 p.m. If you don't leave by 6 p.m., not only will he not pay you the extra money, he'll also make sure you don't even get a dime. So why would you stick around past 6 p.m.? If anything, you will make sure you're out of there by 5:58 p.m. and tell him he can deduct whatever's worth those 2 minutes left from your pay. Or imagine some wealthy philanthropist is throwing money around and making a game of it. You can take as much money as you can catch and put it into a little basket. You may empty out this basket whenever you want to keep your money safe and keep catching more as it falls from the sky. Also, of course, there's a time limit for this. What would you think if you saw someone with a full basket trying to catch more money but losing precious dollar bills because what's in the basket keeps pouring out? Wouldn't the smart thing be to secure what you've got so that you can have room for more? These analogies may sound silly, but it's the exact same thing many new traders do when they're in a trade. They want to get a perfect score. They want to get out at precisely 50 pips. What do you mean get out at 499 points? Are you nuts? So the price gets to their take profit, but the broker's spread isn't wide enough to hit it. Then they sit there and give back everything they gain to the markets and pay the price of greed by having their stop-loss hit. Does this sound familiar? We've all been there. This is why you need strict rules for securing your trades. First, you must work out the price levels you want to take your profits at, whether in full or partially. You should also know how many pips you want to trade to move before making the trade risk-free by moving your stop-loss to break even, accounting for commissions and the spreads. Ideally, the best way to secure your trades is by using price action. When the price hits an old low, if you're selling, or an old high if you're buying, take some money off the table. You could also move your stop to break even after the price has created a new swing low above your buy trade or a new swing high below your sell trade. This way, you won't get knocked out on the inevitable retracement before the rally or the drop. You can use a moving average to slide your stop loss along as the price goes your way. This same practice can work with trend lines as well. For example, you can look at Fibonacci levels, wait to see them broken, and then move your stop loss to the broken level. When the support and resistance points you use have been exceeded by price, this means the market is willing to move the price even higher or lower in your trade direction, so you can move your stop loss close to the damaged areas, leaving enough room for the spread so you're not taken out. Keep in mind that the more aggressively you adjust your stops, the more likely it is that you'll miss out on good moves if the direction is right and the price comes back for your stops in a pullback. If you like, you can use a trailing stop loss and no take profit if you're sure that the price will move your way considerably. Mistakes Forex traders make. There are so many mistakes that Forex traders make coming into the industry. It's sad because it's so easy for anyone to get started with trading as long as they have the internet, a laptop, and a few dollars to burn. If only it were as easy to take money out of the markets as it is to put it in. Before you get into trading, here are things you should be on the lookout for. Mistake number 1. Revenge trading. You enter a trade and it loses. So rather than waiting for another setup, you force the trade and it takes you out again. Now you're Hulk smash mad. So, you go in with max lots because how dare your broker take your money from you? How dare the markets treat me like crap? Give me back my money, you cry inside you. Then you lose it all with just a few measly pips of movement. What happened? Your emotions. We're all emotional. Even the best of traders feel things. So add this to your rules. When I take a losing trade, I will walk away and go do something else for a few hours before I come back to evaluate what went wrong or take another trade. Mistake number 2. Not using a stop loss. This is an excellent way to lose your money. You must make sure every trade has a set stop loss. If you're worried about it getting hit, set it at a previous swing. Don't try to cheat the markets by making it tighter than it should be. Give yourself more room and adjust your trade size accordingly. You don't need to be perfect. You only need to make bank. Mistake number 3. Adding to your losers. When you have a losing position, don't add to your trade. You don't know if the market will go your way. You can't say for sure. Remember, it's all probability. I'll quote this again. The markets can stay irrational longer than you can remain solvent. Allow the trade to play out. If it hits your stop loss, that would be a lot better than losing more than you should have. Mistake number 4. Trading every day. Just because the markets are open 24/5 doesn't mean you have to be in trade the whole time. Sometimes the best setups come in the middle of the week, so don't be in a hurry to trade. Allow the market to show you its plans for the week on Sunday and Monday, and then you can stalk your setups after. Mistake number 5. Cutting profits short. This happens when you've taken a loss or more, and you badly want to make up for it. So rather than allow the trade to go where you expect it to, you take a few measly pips to balance out your account. When you do this, you limit yourself, and you'll really feel the heat when more losers come. Mistake number 6. Using martingale. Unless you have Bezos fat pockets or Elon-esque bank accounts, please stay away from this terrible strategy. Martingale's money management method involves doubling up on your losses when you take the next trade. For example, say you lose $1, then you risk $2. If you win, that should give you $6 with a 1-to-3 win-reward ratio, which puts your account in a profit of $5 net. However, what happens when you have a string of losers, which statistics prove occurs to the best of traders too? You don't want to go down that road. Mistake number 6. Trading the news. It doesn't matter how many times you traded the news successfully on your demo account. Don't do it. Demo market conditions are different from live markets. The increased volatility during news events makes it almost impossible for your broker to fill you in at the prices you want, and the spreads will destroy your account. Mistake number 7. Trading with the wrong broker. Do your homework before you settle on a brokerage firm. Some of them are outright scams. You can trade, but once it's time to withdraw, you won't be able to. So only choose brokers that are accredited and regulated by national and international bodies. Mistake number 8. Trading too many correlated pairs at the same time. Diversification is an excellent strategy to reduce your risk, but it's not diversifying when you trade USD JPY, EUR USD, USD CAD, and USD ZAR simultaneously. What's wrong with this picture? You have dollars everywhere, and not in a good way. If some news happens, or there's a sudden movement in price against you, you could lose way more than you should have. On the other hand, if you notice the exact same setup happening across specific pairs all the time, those pairs are correlated. So just pick the best one. You can also check online to learn more about which pairs correlate with each other the most, whether positively or inversely. Mistake number 9. Trading economic data. The news says the dollar is dropping or will drop. You open up your chart and you see a different story. But you heard it on the news, so they must know what they're saying, and you go short on it. Then you lose. The talking heads don't know what they're talking about for the most part. Observe what they say and what the charts say for a while, and you'll see that too. If they seem knowledgeable, it's only because their statements will happen eventually. Obviously, the price will go down and the price will go up. The real questions are when and at what price. They don't know that. Also, long-term fundamentals don't matter when you're a day trader. News is heavily manipulated. If you know what to look for in the charts, you will find that the levels are already priced in for a particular event involving towers and planes and a specific global flu before those events happened. This sounds like a conspiracy theory, but it's not if you know what to look for. I could easily write a whole book on that topic to show you how, time and time again, the charts show that these events were expected. The silver flash crash, the black swan event, and any other event give the market maker the excuse to take the price they want to go. The easiest way to manipulate the masses of newbie traders is to tell them they should pay attention to the news. A perfect example is Elon Musk shilling Bitcoin. When everyone listened, the price dropped. Meanwhile, he had acquired a fair bit before he made that infamous tweet. As a rule, be fearful when they're greedy and greedy when they're fearful. Mistake number 10. Paying for scam signals and account management. Your broker might have the option to manage your account for you. That's fine. However, if you see some random accounts or comments on YouTube or any other social platform talking about how Mr. Sean Connery and Miss Betty White traded for them and made them a bunkajillion dollars, run the other way. Stay away from Telegram signals too. Most of them will offer you free signals that steal from other legit traders, at best, so you make money, or which are totally made up, at worst, so you lose money, and then ask you to join their paid service. You send them some money, and then they block you. Also, don't pay for any course without checking out the reviews. A lot of these trading gurus are demo ballers and marketers. You can get some excellent information for free on YouTube. Mistake number 11. Believing in screenshots. This one is a doozy, but you can actually set up your Forex charts on MT4 to look like you took an actual trade and caught it right at the bottom. There's also an app that can do this with your phone. This is why I say don't fall for the screenshots. Don't fall for the fake dollar bills either, or traders who claim to live that FX lifestyle, making thousands and thousands of dollars. If you ask traders who have been in the business a long while, they know who that is. If they can show you their withdrawals, then you can believe them. So instead of following what is called trader porn in the industry, focus on your charts and getting better. Now you know the most common mistakes Forex traders, new and old, make. So, the question is, what are the habits of profitable traders who consistently pull in money and keep it? If you want to become a successful trader yourself, then start your Forex journey living and trading by these rules. Tip number 1. Never trade without a plan. If you don't have a trading plan, you won't last very long in the game. You must have a plan for every trade you take. You might be able to wing it successfully in the short term, but one day your wings won't work and you'll go down hard. You want to have a plan for each position, lot sizes, entries, stop losses, take profits, exits, and so on. You can be flexible about your take profits if you have a good reason to anticipate more movement or expect the trade won't play out anymore, but don't use your stop losses to do the moonwalk. Tip number 2. Be flexible. We already know the only thing you need to be rigid with is your stop. However, don't marry your positions. Don't get so emotionally attached that you don't get out even when it's undeniable that you should. Be quick to abandon a very obvious loser, and you will save more capital to take advantage of a better setup in the future. Tip number 3. Always get screen time. So, you took a Taekwondo class 10 years ago and you feel you can beat the reigning champ? Well, I can tell you for sure you'd make a great comedian. You want to keep your skills sharp, and this means looking at your charts. Go through past data for your setups. Remind yourself what works for you and why, and be on the lookout for how you can optimize your strategy. Tip number 4. Know that the trend is your friend until it ends. Following the trend will give you great success in trading, all else being equal. Having said that, when you see obvious signs that you should no longer be in that position but looking the other way, get out. This ties back into staying flexible. Tip number 5. Jealously guard your profits. The market has been giving setups since its inception and always will. You making money from it with every setup, however, is not guaranteed. So, while you may have a plan for unloading all your positions at your take profit level, make sure you're banking pips along the way. This will also help you psychologically. You should get paid for your time and analysis at least. Tip number 6. Use a stop loss. If you refuse to use one, your broker will generously help you set one. It's called a margin call, aka no more money left to trade. Tip number 7. Keep your eye on other markets. Currencies don't exist in a bubble. As mentioned before, pay attention to bond yields and watch what they do. Then, on your own time, research what markets tend to affect the currencies you trade the most. Tip number 8. Trust your gut. When you put in the work, your subconscious mind picks up on many details that your eyes and brain might be missing. Sometimes you'll be in a trade and there's absolutely no reason for you to exit or take partials, but then you get this sense that you should. Right when you do, price travels back the other way and would have taken you out and made you pay 1%. Trading involves intuition as well, you see. So each day, make a point to check in with your gut about major decisions, not just in trading, but in your life as well. With time, you will have an uncanny knack for knowing when to get in and get out or stay out of the markets.